The text messaging part of Grower's Edge is very handy because every day I'll receive a text that shows me where the best local market is.
That's what I like about Grower's Edge too. It gives me the information I want on my smartphone so that if I'm not in the office, I still get the information that I need.
Good afternoon, welcome to GrainTV. It's July 18th, 2014. I'm Logan Burgess. To my right here is Cody Bills to help break down a mixed trade for the grains. We saw old crop corn off 8 1/4, new crop down 8 3/4, testing some important technical support there around 380. Old crop beans showed relative strength, closing up 2 cents. We saw new crop down 8 3/4, and the Chicago wheat complex gave back all of yesterday's ground, closing down 18.5 cents. Once again, the story out of Ukraine was a focus today for traders. Really talk out of Washington is that there's still a lot to be discovered as to what exactly happened in Ukraine. As the grain market seems to be concerned, though, at this point, this doesn't look like a situation that's going to flare up and significantly impact wheat or corn exports out of Ukraine. Obviously, that could change here day by day, but that was the reaction that we saw in Chicago today. If you take a look at beans, we did get news that the strikes down in the Puerto Rosario out of Argentina are back on, so that seemed to support the old crop market once again. That's a situation that we're going to have to see what occurs on Monday. Obviously, strikes out of South America isn't a new event here for the grain market, but considering how tight old crop stocks are, a story like that seems to be supporting the August contract. So a mixed trade in Chicago, as I said. Keep an eye here on December 14 corn as the night session opens up Sunday night and into Monday. As I said, that area of 380 is long-term technical support, so just keep an eye on that. We have a great trading platform here at GrainHedge if you'd like to chart these contracts yourself, and you can take a demo by visiting us at grainhedge.com. Cody, here on a Friday, we do like to kind of break down what we saw in the cash market for grain, for corn and soybeans. Can you kind of break down what we saw this week?
Sure. Well, the first thing we saw really was across the board here for corn and for soybeans. We saw the basis actually decline here. For corn, it was down about a penny. For soybeans, it was down about 2.5 cents. But the thing that's very interesting is when you look at this spatially on a map across the U.S., you'll notice that the major declines here in soybean basis was isolated mostly to the river. When you look at the river here, it actually took a flogging. It was down 18 cents. River terminals on average across the U.S. were down 18 cents here. Now, there's a couple reasons. When you look at the corn map, you'll notice we didn't have that same sort of decline in basis along the river. And that's, the question is, why was that? Well, first of all, we had an increase in transportation costs. Barges are finally available to travel up and down between Minneapolis to the Gulf. We saw the areas that were closed, the locks that were closed north of St. Louis, those are open now. So we do have free flow of barges down to the Gulf, and that's been good. A lot of these grain merchandisers are hustling to really get this grain moved out of their facilities. Typically, they'd be loading, in some of these cases, a couple barges a day, and they've been down here, unable to do that really since the beginning part of July. So they're really trying to lock in barges here to move the grain south, and you'll notice that as a result of trying to get those barges up to their facilities, barge prices have jumped pretty significantly. In fact, they've jumped about 18% in the last 3 weeks since those shutdowns along the river have started. Now, one of the things that you'll notice here, when you look at the Gulf basis, take a look at that, because what you'll notice here is that soybean basis has declined very sharply where corn basis has not. And so what we've seen here is soybean basis declined very sharply and had increase in transportation costs. What we saw was a dramatic reduction in basis along the river, whereas corn here was able to actually improve when you look at the Gulf basis, which was able to offset some of the higher transportation costs. Really one of the main reasons why soybeans was down 18 cents and corn along the river was really only off 2 1/4 cents. Relatively speaking, when you look at soybean basis, you'll notice that the demand centers within the nation here, the soybean crush facilities, are maintaining relative strengths. What that means is that if you do happen to have any old crop soybean contract or grain left here to sell, to market here, soybean plants really are the only gain left here in town. You got soybean basis along the river rapidly declining. The U.S. average is mostly about par, but it does seem that the crush plants are able to improve their basis.
Yeah, absolutely. You know, in a marketing year like this, Cody, where we've seen prices decline substantially, obviously cash sales and the basis received on those cash sales is all the more important. For anybody out there that's considering making cash sales, both on the old or the new crop here moving forward, we have a great basis tool here available to grain hedge clients. And Cody and myself are happy to help you use that tool to get the most out of cash sales. So if you'd like to take a look at that or the trading platform that I mentioned earlier in the show, give us a call at 877-472-4607. Or as always, you can visit us online at grainhedge.com. Thanks a lot for joining us here on a Friday on Grain TV. Have a great weekend. We'll see you back here on Monday.